And the latest credit actions in the Philippine property sector paint an important picture of risk and resilience in the economy. The macro picture shows slower growth and weaker household consumption, compounded by a corruption scandal that has dampened investor and consumer sentiment. So how are these micro and macro signals shaping the country's sovereign credit story? With us for more is Emmanuel Leyco, the President and Chief Economist of Credit Rating and Investor Services Philippines, Inc., and Fellow, Center for People Empowerment in Governance, or CENPEG. It's good to have you back, Noel. Welcome back to the program.
Thank you for having me here.
Okay, so let's start with property, because that picture in property you have defined in two property firms, and that's Century Property as well as Vista Land.
Yes.
What have you come up with?
Okay. Let's just put this in context. A few weeks ago, the President highlighted the role of the government in the property sector in housing, providing housing for our community. But I think we know that the government alone cannot do that, and therefore we need the private sector. And the private sector has been doing this for quite some time now. Recently, we issued credit ratings, so reaffirming both issuer ratings for Century Properties and Vista Land. These are two different issuers. We see Century Properties Group, Inc., as a rising star in the property sector that has established its footing in the vertical housing in the beginning, but about 7 years ago, they started getting into horizontal housing, and I think that was a very timely move on the part of Century. Why? Because right now, if anybody is going to vertical housing, the market is really soft. Not many are getting into the vertical housing.
What about Vista Land?
Vista Land is a major player, it's a veteran. However, in the last few months, they were having issues with high debt. They have debt maturities. Like, for example, in 2026, they will have about 31 billion pesos maturing, and therefore we'd like to make sure that we are the first to know what's happening there. We put the Vista Land issuer rating in Credit Monitor. The major reason for that is maturing debt, 31 billion, and also they have dollar exposure, and given the volatility in the peso dollar exchange rate, we'd like to know how that is developing from their end, and therefore we put them in a in a closer surveillance credit monitor. But we are confident that they will be able to manage.
Well, the market chatter we're getting here is that, and this is according to what we're hearing from sources.
Okay.
Unless a massive white knight investor or a significant political intervention emerges to stabilize the credit lines, the Conglo will face involuntary liquidation by the middle of this year.
Okay.
How plausible is that?
That's not what we saw for Vista Land. Remember, it's a conglomerate, like you said. They might be talking about other branches or other businesses of the conglomerate. But Vista Land, we saw a massive land bank, and still being able to manage their debt. They have financiers, and banks are still ready to do business with them. Recently, they did 11.6 billion pesos. They extended to Vista Land. So we think that this will continue. But be that as it may, we will be the first to know. And we will report to the community, to the public, what's going on.
For Money Talks to be the first to know, it's two different pictures you show of one sector, and it's property. And the fact that this is happening in a situation where we have a slowing economy and the after effects, the economic after effects of a flood control scandal involving infrastructure that's cut back in private spending, I'm now wondering, what impact will this have on our credit ratings and credit risk?
Okay. The last credit rating review that we saw was November 2025. They have not shown the actual growth rate, GDP growth rate of the Philippines that went down to about 4.4%. That is not what they were projecting. They were projecting something like 4.8 or even higher than 5%. So when the new numbers came in, the actual numbers came in, I'm sure the other credit rating agencies will also take a look. Are we in solid ground giving the country rating, the sovereign rating of triple B plus? Remember, triple B plus is an investment grade, but that is just one notch away from an A plus or an A category, which is great.
Are we at risk of a sovereign ratings cut?
We could be at risk if the government is not able to show sound fiscal management, fiscal policy, just like what the Banco Central governor said. The monetary policy can only do so much in managing the total economy. Fiscal discipline will have to come in, and the government will have to show that it's seriously managing the economy, managing its debt, managing its budget, and the government is able to show to the people that whatever plunder or whatever misuse of our government funds happened in the past, that is now being addressed.
All right. Well, we'll pick up on the fiscal picture as soon as we get more information from the fiscal side of government. Thank you so much.
Thank you.
Much appreciate the insights. Emmanuel Leyco of Senpeg and CRISP.